Today, we're going to pull back the curtain on a powerful, kind of hidden force that can completely change the market's personality on any given day. It's called gamma, and trust me, understanding it might just change how you see everything. When you see a huge market swing, what's the first thing you think of? It's always more buyers than sellers or the other way around, right? But what if that's not the whole story? What if there's a mechanical, almost automatic force cranking away behind the scenes, one that comes from the very plumbing of the options market? Well, that's exactly what we're going to get into.
All right, so let's start with the big one. What in the world is gamma? It sounds super technical, I know, but we're going to break it down into two really simple steps. And you'll want to pay attention because this is the foundation for everything else. So to get gamma, you first have to understand its sibling, delta. Think of delta as the speed of an option. It just tells you how much that option's price is going to move for every dollar the stock moves. Simple enough? Now, if delta is the speed, then gamma is the acceleration. It tells you how fast that speed, the delta, is changing. It's the rate of change of the rate of change. So here's the bottom line. Gamma is all about reaction time. If you have high gamma, it means things are changing super fast, and certain traders, who we'll meet in a sec, have to adjust their positions like crazy. Low gamma, things are way more chill. You can think of it as the market's accelerator pedal. Okay, so we know what gamma is. It's the acceleration of an option. But how does this abstract idea actually push around something as massive as the S&P 500? This, my friends, is where it gets really, really cool. It all comes down to these key players called market makers or dealers. Their whole job is to sell options to people like us. But they're not trying to bet on the market. They want to stay totally neutral. So to do that, they hedge their risk by buying or selling the actual stock or future. But here's the kicker. As soon as the price moves, their hedge is instantly wrong. And because of gamma, their risk has changed and they are forced, they have no choice, to jump back into the market and buy or sell more futures to get back to neutral. And this is the part you absolutely have to remember. The buying and selling these dealers are doing, it's not based on some opinion or a fancy chart pattern. It is a mandatory mechanical reaction. It is a giant non-negotiable wave of money that has to hit the market, and that flow directly moves prices. So what's so wild is that this one mechanical force actually creates two totally different, almost opposite market personalities. And if you know which personality the market has on a given day, it's like having a cheat sheet for how it's going to behave. This slide nails it. On the left, you have long gamma. I like to call this the stabilizer. In this mode, when the price goes up, dealers sell. When the price goes down, they buy. See what they're doing? They're fighting the move. This acts like a giant shock absorber on the market, leading to calm, choppy, range-bound days. But on the right, you have short gamma, the amplifier. This is the exact opposite. If the price goes up, dealers are forced to buy more, pushing it even higher. If it goes down, they're forced to sell more, pushing it even lower. This is what creates those crazy, volatile, trending days, where breakouts just keep on running. Okay. Theory's great and all, but let's look at how this really works. And probably the most dramatic example of gamma's power is how it can pour gasoline on the fire during a market crash, especially when we're in that scary short gamma environment. So just picture it. The market's already a little nervous, and dealers are short gamma. Then you get a small drop, maybe just 1%. Boom, that's the first domino. Dealers are now forced to sell futures to fix their hedges. But what happens when a giant wave of selling hits an already weak market? It pushes it even lower, of course, and that new, lower price forces them to sell even more. This kicks off a vicious feedback loop where the very act of hedging actually fuels the crash, making it faster and way more intense. Now, a really interesting question is, does this work the same way in every market? Not exactly. In big index futures like the S&P 500, the options market is dominated by a handful of massive dealers. This makes the gamma effect really strong and kind of predictable. But in something like crypto, the game is totally different. The liquidity is spread out all over the place, so there isn't that same central group of dealers. The gamma effect is still there, for sure, but it tends to be a bit weaker, pops up more sporadically, and is just generally more chaotic. Okay, we've gone over the what, the how, and the why. So what does this all mean for you? What's the bottom line? Let's just boil all this down into one simple, practical rule. And here it is. This is the whole thing in a nutshell. When the market is in a long gamma state,
the stabilizer, the play is usually to fade the moves. You sell the rallies, you buy the dips, because the market wants to snap back to the middle. But when the market is in a short gamma state, the amplifier, you do the opposite. You want to follow the moves. You ride that trend because the underlying mechanics are literally pushing it in that direction. At the end of the day, this isn't about having a crystal ball. It's about knowing the market's personality right now. Is it the kind of market that's going to stay stuck in a boring range, or is it coiled up and ready for a huge breakout? Knowing the gamma environment gives you an incredible edge in answering that question. So, the next time you see the market going wild, just ask yourself, is this really just buyers versus sellers, or is there a massive, hidden, mechanical flow at work? Because in today's markets, it's way, way more powerful to understand the flow than it is to try and fight against it. Thanks for tuning in.